Real estate investment practice problem using OneNote. Amortization schedule, changing the loan amount, holding other factors constant, looking at the impact on the payment, the amortization schedule, and other factors. Get ready because it's time to raise the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab. We're in the 4125 Amortization Schedule Loan Amount Changes tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts, they can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're going to be going through our data set, but this time holding everything else constant except the loan amount, looking first then at what the impact will be on the payments, which is usually the first focus that we will have, and then later looking at the impact on the amortization schedule as well as the year-by-year breakout. Now, we do this in Excel as well, but it'll take some more Excel jargon and formatting to go through that practice problem. Once you see it here, you can see whether or not you would want to put this together in Excel and or simply use the Excel worksheet to do whatever you want to do with it, make the decisions you want to make. So we're going to be now changing the value of the home as opposed to last time and the value of the loan as opposed to last time when we looked at the change in the percent. In a next presentation or a future one, we will then change the terms. Those are going to be the major components when you're calculating the payment calculation. The payment calculation down here is going to be adjusting then automatically. So our information up top, starting point, we've got the $440,000 on the home value. Also note that this home value is something that may or may not be on your worksheet. If you look at some of the online type of calculators, for example, you'll see many of them will simply start out with the loan amount here and then calculate the payments from there. So the question is, do you want on your worksheet to have the home amount to then take the down payment percentage, calculating the down payment and the loan amount, or do you simply want to start with the different various loan amounts from there, which might be a little bit more simplified on your worksheet? Here, we're going to assume the home value purchasing process, $440, calculate the down payment with a standard fixed 20%, so 440 times 0.2 or 20% would give us the $88,000, and then if we take our 440 minus the $88,000, that would give us our loan amount of the $352 in our starting point. So that gives us a little bit more of a tweak in our complexity, because now when we change things up, we're going to say, I need to change the home amount in order for it to adjust and calculate the loan amount down here. So the cell that we're actually going to be adjusting then is not simply the loan amount here, but the home amount, which will lead to 20% being taken away to get to the loan amount, or in other words, 80% of the home. For Excel, that'll be a little bit more of a twist. So if you want to see how we do that in Excel, you could take a look at that. The first thing that we might do to do this is to say, I would like to see a list of different home amounts that will result in different loans here, because 20% of it will be the down payment, and then see directly what the impact would be on the payments. So we're going to say, if I had different home values, how can I automatically calculate the payment side by side? Now, you could do that by simply changing the home value here, which would then change the payment down here, which is great. But you can only do that one by one, changing the value one at a time. It'd be nice to have a series of payments, this one starting from $200,000, increasing by increments of $20,000, and see what the impact on the payment would be on a side-by-side basis. And that can, be a little bit easier for us in our decision-making process. Now, you can see this one right here, for example, what we have here in our data came out to a payment of $1,889 or $1,890, about $440 on the loan amount. So if we look at the $440, we got the $1,889 about on down below. So to do this, we'll first do our payment calculation just to show how the payment calculation will look. Again, we got a little bit of a twist here, because we're trying to calculate the home value to get to the payment rather than just starting with a loan. So you got a little bit of a twist. We'll do the payment calculation. So let's pretend we're on this one down here. The calculation would look something like this in Excel. it would be negative payment to flip the sign to get a positive number. You could put that negative in front of the present value, but I like putting it up front when I can. The rate is going to be fixed. That's going to be the 5%. It's referring to that cell. That's what the B7 is. It's absolute $ before the B and the 7 because we do not want that cell to be moving down when I copy the cell reference down in this case. That's a yearly rate. We want a monthly rate because these are monthly payments. Therefore, we divide by 12. The comma then moves to the next argument. We have the number of periods. The number of periods also constant. It's going to be 30 times 12 or 360. So we're referring to that in our data set. It's outside in the data set. Therefore, we need it to be absolute, not to move down, $ before the B and the 6, comma, next argument is going to be the present value. The present value is the loan amount because that's our starting point. So the PV is the loan amount. If we were designing this table to have the loan amounts here instead of the home cost, it would be just simply this cell right there. And then we can copy it down, not having it absolute, and just copy it down. However, we're trying to get from the home cost to the loan amount. So in our calculation up top, we're going to say that there's 20% to get to the down payment. Therefore, the loan amount is going to be 80%. Or in other words, you could think of 440 is the amount of the home in this case. And if I multiply that times 0.8, which is 100% minus 20%, that means 80% is the loan value. That's going to be the 352,000. So if I'm looking down here, if this is going to be the home value, the 420 in my cell reference, I would like to calculate that using this cell. So I'm going to be saying, okay, we want to take this cell, which is the 420, that's going to be represented by A27, no absolute reference because I want to copy it down, times, and then you could say 80%, 0.8, but we don't really want to do that in the event that we change this cell, for example, to be 10% or something other than 20%. So we'd like to say brackets. So we have the order of operations, 1 minus the 20%, the down payment, referencing this cell, which is outside of our table. It's in our data set. Therefore, we don't want it to move down. We want it to be absolute. That's why we have the $ before the B and the 2. And that then will give us our payment calculation. If we copy it down, we have the same calculation down here, payment. You can see the rate is the same cell, absolute references making it the same. That's going to be the 5% divided by 12, comma, number of periods, same cell, B6, $, meaning it doesn't move down. That's the 360. Then, comma, the present value references the home price here times, in essence, 80%, but calculating that 80% by taking 1 minus the 20% rate, making that absolute so that rate cell doesn't copy down. The B2, same. The only one that does copy down is this cell reference, the home value, which is the A20, which the A27 would copy down if this were two separate cells here. This is the same formula being referenced. The next thing we might want to do is that nice fancy little drop down that we'll do in Excel if you want to practice doing that, putting this drop down to reference from this list of home prices so that it'll be pulling from this list of home prices in our worksheet. So we'd say this cell, that's going to be the changing factor, which will automatically calculate the loan amount, which will then be used in conjunction with the other fixed variables to calculate the payment amount here. To do that little list drop down, you can hit once again in the Data tab and the Data Tools, this item right here. And then you would select this range of data, the home costs, and that will give you this drop down that you could put in the home value. So the tricky, nice little feature, you can look at how to do that. We do that in the Excel problem if you want to look at that in more detail. Now, the next thing that would populate automatically is our amortization table, which we thought about and we've looked at how to construct in a prior presentation, so we won't do it again here. But if you were then to add a table function to it, you got then that nice splitter option, so you could see actually the month-by-month payments, and then you could split it up, or the slicer, I should call it, which is in essence a filter, and you could filter it by year if you set up the amortization table properly as well, and that will give you another function. The next step would be to add the pivot table again. We won't go through the process in too much detail on how to do that. We looked at that in prior presentations, but just remember the pivot table can give us that year-by-year breakout much more easily and help us to kind of sort the data a little bit more easily. This is what the pivot table would look like. And to populate, then we're going to add the years, the payment, the interest, the loan reduction and the loan balance, giving us this information on a year-by-year basis. It would have 30 years rather than 360 amounts on an amortization table, giving us the interest broken out on a year-by-year and the reduction in the loan, and then the balance on a year-by-year basis. The interest being quite useful oftentimes for budgeting, for taxes, as well as the loan balance in the event that we're thinking about where we will stand at some future point in time on a year-by-year basis. So again, we do this in the Excel problem. You can look at how to put this together, and in prior presentations, we talked more about how to make the pivot table. Then once you have the pivot table, remember, then you can use the pivot table to make more data sets that might be useful for you. So for example, you might say, I would like to, holding the interest rate constant at 5%, for example, look at what my interest payments would be if I had different home value amounts, meaning what if I had the home of 360, 400,000, and the 440, holding everything else constant, what would be my year-by-year breakout in terms of how much interest I would pay? Or we might say if I had 5% interest and I changed then the value of the home, what would be my year-by-year breakout for 30 years if I had different home values of 360 versus 400 versus 440? You can construct something like this fairly easily by simply changing your data set up top from 360 to 400 to 440, right-clicking on your pivot table, refreshing it, and then simply copying the interest columns and possibly the loan balance columns into your worksheet one by one down below. So it's a little bit of a tedious process, but not too difficult. And then you can do some comparisons this way that you could pull the data much more easily than you would, of course, from an amortization table with 360 rows in it. And then you could do your comparisons here and say, well, what if I had the purchase of 360? How much interest would I pay, say, in year 11 versus the 400 home versus the 440? Where would I stand in terms of loan balances at the end if I after 10 years, let's say, for a 360 home versus 400 versus 440? You could do comparisons, like that with a lot more detail. Now, these tables down below, you would have to copy and paste 1, 2, 3 values only. They would not change as you change the data set, but you can change the pivot table to pick up that data to make further types of calculations that can be relevant. So once again, this is just some ideas that you could take a look at. And you can think about if you want to build something like this worksheet. We have a step-by-step Excel problem that you could put it together, and or you could use the Excel worksheet that we put together if you think that would be relevant for your current decision-making processes.